Hi, hi, and welcome. What I'd like to discuss this evening is the fact that profit is an opinion and cash flow is a fact. And cash, not just the flow, is a fact. You either have the money in the bank or you don't. But I thought before sitting down here that I would tell you a story. It's actually a joke. About the chief executive officer of a large company going along to see the CFO because the year end was days away and asking the CFO, what will our profits be this year? And the CFO said, I don't know, you haven't told me what you want them to be. Now that's a joke, but how is this sort of thing possible? Where did it start? Well, assets have to be reduced in value over time in our accounting records by a process called depreciation. They've depreciated in value. So the first thing I want to just talk about there is the fixed assets. These are the items that get depreciated. So this could be buildings, plant and machinery, even vehicles, delivery trucks. They may well move around, change shape as they reverse into concrete pillars, but they would be referred to as fixed assets. Now, in order to reflect the value of our fixed assets in our records, what we need to do is to take a view over what period we would depreciate these assets. And who is going to decide on that period? It will be the management. Now, there will be different views. Now, while there may be guidelines from the tax authorities on what they call the wear and tear allowances that people are allowed to claim, which is like depreciation, but sometimes companies will depreciate their fixed assets over a longer period because that is what they believe the value is over time. And of course, this then would increase their profits, and of course, they pay more tax. But that's fine. Sometimes there'll be disagreements, not unpleasant arguments, but about the depreciation rates which should be applied. Now, let's imagine you have for a moment acquired some new high-tech type equipment that you're going to use in the company. And some group might say, well, we'll depreciate this over 5 years. And somebody else would say, oh, please, man, this stuff changes every year. We'd have to depreciate it in 1 year or 2 years, but not 5 years. So that's the sort of toing and froing that goes on. The depreciation, therefore, is an opinion, and that opinion affects the profit. But it should really be based on a realistic expectation of the life of an asset. Now, private business owners may take a different view on things. They would like to depreciate things as fast as possible because this would reduce their profit figure every year while not affecting their cash flow. And then they hope to pay less tax. They might push the limits of what they could get away with as far as the tax authorities are concerned. But it's a game, and they don't always get away with it. Whereas managers now, who are going to be in the company for the foreseeable future, they hope, they want to see the profits be as big as possible because there are two reasons. One is they might be under some profit-sharing incentive scheme, or they might own shares in the company and they want the profits to show good returns on people's investments. So this would affect their view on depreciation. It's not being dishonest, it's maybe just having the wrong opinion. So, other assets to which adjustments are made fall under the heading of current assets. Now these are things like accounts receivable or debtors. Now here, a responsible manager or group of managers might sit and discuss certain clients who are in arrears with their payments, and they might say, well, there's something wrong here. They might have heard something out there in the marketplace that company A is in trouble and company B's also in trouble. So what they then do is to say, okay, we've got to take a view on this. And any other customer they're worried about, we've got to take a view on this and then adjust the value of that asset related to that. So they go down the whole long list of their customers, and based on information they have, they would then reduce the value of their debtors, and that would be a provision for bad debts or doubtful debts, which then is an expense. The other thing that we have to take a view on regularly when we're doing management accounts and year-end accounts is inventory, or some people still call it stock. Now, what can devalue inventory? Well, damage, which might reduce the price at which we could sell it. It could be obsolescence, that the demand is no longer as great as it has been, and therefore we need to reduce its value because it is now worth less. So those are legitimate opinions to have and to implement. But the key thing is, though, to remember that all of the rates of depreciation, all of the write-downs of debtors and stock are people's opinions. And so one needs to take a closer look and ask some questions if some of them don't look too right for you. So, thank you for watching.